going to do a couple of things. We're going to go over the syllabus, and then we're going to start in on chapter 1. And just so you guys know, these are recorded. So if you miss a meeting or whatever, you can. It usually takes about a day for it to get up. Not to bore you with the details, but once it's done with the meeting, it takes about an hour to render, and then it takes then I have to edit it to put it into YouTube, and that takes like about another hour, depending. And then YouTube is kind of funny that it might take 10 minutes and it might take 10 hours to render it. So anyway, it's certainly up by the next day, though. I usually try to get them in the same night, but it doesn't always work out that way. So anyway, so if you do ever miss a meeting, not a problem. You can go in and check, and it'll be in the recorded meeting area. Let me. So just to kind of show you, I'm going to make these available tonight. This is actually from a different class. So the Zoom meeting, this is what we have for this class. And then here's the recorded files. This is from a different class. And you just click on it and it'll pull up the video. You guys, I'm sure you guys. Oopsie daisy. I'm sure you guys have seen this stuff before. So anyway, they're all available in there. The ebook, I don't have that up yet, do I? I do have it up. And so we have credit meetings. Then there's also going to be a course files, and this will be available. And this is again from a different class, but all of the files. So if you weren't able to make it to a class, you need a file or whatever. They're all listed under course files. So basically, these first 3, and actually 4 will be the ebook, are really the ones that you're going to mostly be working with. So anyway, and to submit work, you go in here. And again, this is for a different class, but assignment exam submitted here. So we're going to do the chapter 1 handout. I don't know if I think we should finish it tonight. I'll see. But anyway, you'll click on this and submit it here just like you normally would. It's so that all those will be the first 4 or whatever things there will be really what you're going to deal with. Okay, so let's take a look at the syllabus. And hopefully you guys got this. It should be in your email. Class time, I'll fill this in and post it. And this is, you guys know this is a very short class. It's a 5-week class, so it's going to be kind of intense. And office hours, they can be available any other time. We're going to meet 3 times a week for about an hour, hour and a half. And anytime other than that, though, if you would like to have tutoring or whatever, feel free to contact me. Blah, blah, blah. Oh, not blah, blah, blah. Where's the textbook? The textbook. Okay, for this class, for this 5-week class, you do not need the online key, the ebook code or whatever to turn in assignments. Now, you may still want to get it, but you don't need it for this one. And the reason I say you may still want to get it is that it is the Accounting 210 and Accounting 211 have the same book. So whoever you have for Accounting 211, they may require it. So you may be required to get the key for that class. But in this class, you don't need to have the key to enter, say, homework and all that kind of stuff. Most of it we'll do not by hand, but on the screen here. You'll see it in a few minutes here. The book, we'll do a few problems out of the book. The book is not the class. Okay, so the book is along with the class. It's not the entire class. So we will use it when we need it and not use it when we don't. But anyway, the textbook, you can get it used. I think this book has been out for 2 years. I'm not positive. I think it's been out for about 2 years. So you can probably pick them up used for very cheap. You can probably sell it for the same price as you paid for it. Again, I think they've been out a couple of years. So anyway, the textbook is, you can get it how you want. You can rent it even, but it's out there. So again, you do not need the code for the class. Okay.
So sorry, really quick. So the ebook, that's the textbook, right?
Correct.
Okay.
And you don't need to use that either if you don't have the code for that.
Okay.
You can just buy a hardback one. You can. Again, for this class, I'm very flexible. However you want to get it is fine. But again, your accounting 211 instructor may require it, so keep that in mind. And again, it doesn't matter to me how you get access to it. Okay, we need objectives or something if you want there. All right, the grading for the course is basically we have handouts, practically for each chapter. So this is 20% of the class. So today we're going to start on a handout. That handout, you're going to complete it, turn it in. All those handouts and practice exams and basically every textbook problems, all those things that we do that are not exams are 20% of the grade. And the exams are, shouldn't do that. The exams are 80% of the grade. And basically, after we do the practice exam, I'll send you the exam, and you have plenty of time to work on it. I give a week to work on it. So the exam, the due date on the exam will be a week from whenever we do the practice exam. Now, this is a very short session, so keep that in mind. We do a couple chapters a week for the most part. So I would encourage you not to get too far behind. As far as submitting the work, I will take the work all the way up through the end of the session, which is July 5th. I think I actually have a schedule for a July 6th class, but July 5th is the last day of the quarter, or the session, I should say. So I'll take everything up until that date. However, don't leave it up until that date for a couple of reasons. Obviously, it's easier if you just keep up with it. But second of all, and they build on each other. Chapter 1, chapter 2 builds on chapter 1, and chapter 3 builds on chapter 2, and so on and so forth. So keeping up on it really helps to keep you on track. And again, if you miss the first couple of chapters and you come in the third chapter, fourth chapter, or whatever, it tends to be fairly difficult to do that, just because the background information isn't there. So anyway, and another thing is for incompletes. For incompletes, you generally have to have 75% of the classwork in. All right, so if you're missing half the classwork when you get to week 5, there's really not going to be something that I got to clear it with the dean to get an incomplete. So just keep that in mind, that it's a good idea to keep up with it. I'll put it there. All right, and this is pretty much what we just talked about. Scale. Okay. As far as the actual classes, or the actual what we're going to cover, if there's one we're going to not get to, it's probably going to be this one. I'm going to leave that one to the end. Chapter 3. Chapter 3 is the hardest It's probably the hardest chapter in the whole book, to be honest with you. So the adjusting entries, quite honestly, unless you're going to be an accountant, you probably don't need those so much. But the adjusting entries, if there is one of those that we're going to wait till the end, it's going to be that chapter 3 adjusting entries. So it'll probably go 1, 2, 4, 6, 7, 8, 9. Those ones we should be able to get in. But the adjusting entry one is we could spend the whole 5 weeks on it if we wanted. And we don't want to. I don't know, policies, blah, blah, blah. Like there's all kind of boilerplate. Probably seen this in all your classes. Pages and pages and pages. All right. So any questions on the class? So here's kind of the tempo of the class. Basically, for every chapter, let me pull up a different screen here. Come on, you. Sorry. Just learn how to use a computer here. Okay, every chapter. Sorry about that. We usually start with the handout. We'll do some textbook problems. Some, not for all chapters, but many of them will. Practice exam, and then an exam will be the last thing, obviously. And the exam is worth 80%. You want to make sure you get the exams in. Not that these other ones aren't important, but the exam is 80% of it. You can pass the class without doing these other ones. You cannot pass the class without the exams. And the exams will be given, and you'll have 1 week to do it. That'll be due. But even if you don't make it for that due date, here's what the due date does. The due date is the date that it will enter into your grade to date. So when you see your grade to date, that is as of the due date. If you don't turn it in, you're going to get a 0 for it until you do turn it in. Obviously, if I don't have any grade, I can't give you a grade. So if you have a 0 for it, it just means that it's past the due date. It does not mean you can't turn it in. You can, and there's no penalty. But until you turn it in, obviously your grade's gonna not look very good. Any question on that? So for every chapter, you'll turn in 2 or 3 assignments. Certainly the handout and the practice exam and some of the textbook problems, and then also the exam itself. Okay. Well, let me see here. All right, so the next thing we're going to go ahead and right in and jump into chapter 1, and we should finish the handout or at least come close to it. Okay. Okay. Share my desktop with you. So this is the chapter 1 handout that you guys should have all gotten. I'm gonna take all of these things. By the way, I'm in my basement, so sometimes you might see someone walking in the background to um, you know, get milk or something from the fridge down here. Okay, some of this you may have already had in your other classes. So general information about corporations, and this is what we're going to really kind of focus on in this class, are corporations. And corporations are completely separate from the owners. As a matter of fact, they're almost like another person. So IBM is almost like a person. And they can do most of the stuff that a person can do. They can hire people, they can fire people, they can sue, they can be sued, they can own property, they can do all these things that a human can do. The only thing they can't do is vote. So a corporation is sort of like a fictitious person, and it's completely separate from the owners, the same way your neighbor is completely separate from you. These are completely separate from the owners. And okay, so it's sort of like a fictitious person. Now, the beauty of that, having it as a separate person, is that same thing for your neighbor's a separate person from you. If your neighbor gets sued, it doesn't really have any impact on you, right? I mean, not you want your neighbor to get sued, but the idea is that if your neighbor gets sued, it doesn't. Same way with a corporation. I may own a corporation, but the corporation itself is a separate thing. So if someone sues the corporation, it's not going to have any impact on me. Now, the corporation might lose money and it might go bankrupt or whatever, but that won't change me personally. They're not going to come take my cars or the house or anything like that. So it's a fictitious person and it's completely separate from the owners. So, and that's why.
I'm sorry. Sorry, I didn't mean to cut you off.
No,
where can I find the handout? Because I'm sorry, I'm searching for it and I cannot find it.
It should be in your email. Wasn't it in your email?
Oh, it's something. Okay, I thought it was going to be in like Blackboard. Okay.
No, they will after this week. They will.
Okay.
Well, here.
Yeah. I do have it in my email. I can open it up from there. Thank you. Okay. Sorry.
Yeah, no, that's fine. Yeah, and usually they'll be in both places. This is kind of unusual.
Okay.
For some reason, they didn't have any of my classes set up in Blackboard for a while here. But anyway, that's not my problems. Yeah, so anyway, it's a completely separate person from you. And then, so what they said is limited liability. You can lose your investment. You can lose whatever you build up in the corporation, but the corporation itself is completely separate. And if it goes bankrupt, it's it's not going to personally involve you. Okay, they are granted by the state. Have you guys had this in your classes, by the way? I don't know if there's some of your business classes or management classes that have it.
No, not yet.
No. Okay.
Some of from like business law a little bit, but
oh yeah, right, exactly. Corporations are granted by the state, not the federal government. They have a state, or the states grant corporations, and they have different rules for different states and so on and so forth. It used to be in the past, you'd have to go through the state legislature and go in and ask them if you could be a corporation. You can imagine lawyers and all that kind of stuff making speeches to get these granted. Nowadays, you can fill out a form and pay a fee, and you can become a corporation. But anyway, it's granting for this separate thing. And here's the really great thing about that. This goes back again to that being completely separate. Before they had corporations, if you were running a sawmill, if you got sued, they could come and take all your stuff from your house and all that kind of stuff. It was one and the same. Furthermore, if you worked in a sawmill, you probably had to know about that business. everyone knew the business they were in pretty much. So if you were, whatever, a blacksmith, you had no blacksmith. Basically the business was whatever your profession was. The nice thing about corporations is because the owners are completely separate, you can invest in corporations that in areas you have no idea. Maybe, I'm not a tech person at all, but I can buy Microsoft stock. I can invest in Microsoft. I can be an owner in Microsoft, even though I have no idea how computers work. I can do that. And so this allows companies to raise huge amounts of money, and some companies need huge amounts of money. Microsoft being one of them, to raise large amounts of money, they had to have these corporations, the people being separate. So you could invest in a railroad without knowing anything about running a railroad. So corporations are extremely important to developing business and so on. Okay, and they're granted by the state. Again, the state says there's a fictitious person, and that sort of. You'll find if you have a bank statement, look on the bank statement. Almost all banks are incorporated in Delaware. You find them calling they even call them Delaware corporations because they have very lax rules, and they kind of let you do whatever you want. So you'll see Delaware corporations all the time because it's very easy to get it incorporated in Delaware. Okay, may have one owner, a shareholder, or millions. You can own a hot dog stand, and that hot dog stand can be a corporation. You fill out the forms and state, and list the whatever the cart or whatever it is for your assets, and that's it. Maybe privately traded or publicly traded. Publicly traded ones probably most about. This is like IBM and all that kind of stuff. So publicly traded ones are the ones you mostly hear about, IBM, for. But the privately traded, the hot dog stand, you can't go buy stock in the hot dog stand most likely. It's probably going to be owned by one person. It's possible you can buy it, but a lot of times they're not. It's called private. It's not that anyone can buy it. Publicly traded means anyone can buy it. You don't pick and choose who buys that stock. IBM cannot control who buys their stock. Anyone can. You might not even like the people that are buying it, but it's the way it is. 7, we already talked about this. Owners do not always participate in management, and for publicly traded companies, it's especially true. Most of the owners do not. Most of the owners of IBM do not work in IBM. Okay, now there is a problem here because of this separation. The owners are separate from the business. In the past, if you were a blacksmith and you ran a blacksmith line, you knew exactly what the business was, how well they're doing, how much money they're bringing, and all that kind of stuff. Because you have now this separation, the owners are not in the business every day. Somehow you have to tell them what's going on with the business, right? I mean, you can't just walk into IBM. Oh, I own IBM stock. Walk in and start looking through the records. You can't do that. So they will issue financial statements, and these financial statements will basically let you know how well the company's doing, at least financially. So these are the financial statements, and these are standard. Let me try to go into the color here. And there's an income statement, statement of retained earnings, and a balance sheet. And these are the 3 financial statements we're going to look into. There's also this one down here. Let's make it a different color just to highlight that it's different. And I say it's different because we're not going to cover it here. So, I got 2 computers at this desk, so sometimes I start typing in the wrong keyboard. Oh, keyboard's not working. All right, so the statement of cash flow is an important one, but it is not, we're not gonna cover it in this, but it actually is a little bit complex, which is why we're not gonna cover it right now in this class. But the statement of cash flow is not covered. So income statement tells how much money is made or how much profit is made. Statement of retained earnings is earnings are like profits. It's the company has kept some of the earnings to grow. And it's sort of like the owner's piggy bank, which we'll talk about in a little bit more later. And the balance sheet. And the balance sheet is just all your stuff and how you got it. And these will be made more apparent on the first problem here. Okay. So let's go to page 2. What you're hearing is a shim to a go-kart. All right. So what we're going to do is make the basic financial statements, and this is for a Zephyr company. So Zephyr Corporation, I just made that up, but the Zephyr Corporation, again, they're separate from their owners. It's a corporation, and let's not do that. And so their owners will want to know how well they're doing. Reasonable. If you own some place, you want to know how well it's doing. And so they will put out financial statements. And these are the financial statements we just talked about and we're going to go over. They usually do financial statements. Well, first all companies will do them on a yearly basis. A lot of them will have a December 31st year end. Not all of them. You could have a January 31st year end, or a June 30th year end. You could have any, whatever year end the business wants, they could have. You're gonna see a lot of them that have December, simply because that's where the taxes. Okay, and down here we have our 3 financial statements, which we'll get to in a second. Okay, so here are some of the accounts that the company has. And some of them are stuff that you can readily identify with cash, so equipment, kind of know what that is. And some of them are a little more unusual. Probably seen them for the first time, or maybe not in this context. Okay, so the first thing we're going to look at is the income statement. And the income statement is there to let us know how profitable the company is, how much money did they make. Now, we're going to, if you want to know that something's profitable, you'd compare the money that comes in with the money that goes, what?
Out.
Yeah, and that's all the income statement is. It looks a little strange maybe in the format, but what comes in versus what goes out. What comes in, we call those revenues. Oops. Okay, so coming down here, we'll have our, at the top here. So here's our revenues. Make those green. So that's money coming in. What account here looks like money going out?
The rent expenses and the salary expenses.
Yep. Exactly it. So these are money going out. So this is what we're going to compare to our revenues. Okay, so rent expense. Oops. And by the way, go ahead and fill the, well, first of all, don't spell like I'm spelling. Go ahead and fill these in, and this is what you're going to turn in, these handouts. And by the way, if you want to print them out and do them by hand written and take pictures, that's absolutely fine. Or if you want to do it on notebook paper, that's fine too, and then just take pictures. When you turn in the, when you make the submissions, it's unlimited. You can put as many documents in there as you want. So if there's a handout with 12 pages, you want to do by hand, do the 12 and take pictures of 12 pages, fine. That's fine. Okay, so rent expense. Salary. Oops, oops. Hey. Okay, so these are going out. So what is left over, we call that our net income. So we'll take 54,000. This is time for Mr. Calculator. I'm gonna switch.
It's the salary expense out is 19,800.
Oh, thank you. Yes, yes, yes. Some people ask me why I'm not still working in accounting. That's why. All right, so I'm going to change my camera here for a second. All right. So, we'll focus dog. 54,000.
So it's gonna be 24,600.
24,600. So this is the net income. This is how much money that was made. It's kind of funny. This probably doesn't need it. So this is the amount of money that was made for the period. Oh, by the way, net income is sometimes called net earnings or earnings. The same thing. You'll actually see a lot more companies call it earnings than income. It's the same thing. So net earnings and net income are the same thing. Okay, so this is how much profit they made. And obviously if you want it to be positive, and the bigger this number is, the better. And another thing about this net income though, is that this is the most important number. When you hear somebody talking about revenues, oh, the revenues were, went up by this amount or whatever. That's really not so important, because it matters what the income is, how much went out. So revenues are coming in, not important, but the most important number is the net income, because that's the number that actually left over. Okay, statement of retained earnings. Ooh, what happened here? Statement of retained earnings. Looking at these other accounts here, which account jumps out as far as statement of retained earnings?
The retained earnings.
Yep. So retained earnings, we're going to start with that. These are actually the beginning retained earnings. So beginning retained earnings was 30,000. Now, retained earnings is sort of like the owner's piggy bank. We talked about this a little bit, but the retained earnings is this is money that they've earned, right? It's like income. It's like retained income that they have not paid out. usually it's because they reinvested it in the business. So beginning retained earnings is 30,000. Now, if we made another 24,600 of income or earnings, will that add or subtract from the retained earnings?
Wouldn't it add to it?
Yep. So what we're going to do is take this number. So we're going to add, so this is the same. So this net income is the same as that net income. So before we even go any further, you can kind of tell that you need to do the income statement first before you do the statement of retained earnings. Right? Because if you don't know the net income, you can't do the statement of retained earnings. Okay. Now, do either of you know how, or well, three of you, I got three of you now. Yeah. How do you get paid from a company? What do they pay you with? If you own IBM stock, what do they pay you as an owner?
The dividends?
Yeah.
Yep. So these dividends are going to be what they pay. So this is money going into the piggy bank, 24,000. The cash dividends declared is going to be money going out. So this is money that was paid out to the owners. It was paid out of their piggy bank. Okay, and this will give us our ending retained earnings. Time for Mr. Calculator. So we're going to add the income.
So it's gonna be 52,200.
So that's our ending retained earnings. So the owners still have 52,000. By the way, so this is the owner's piggy bank. If the piggy bank has zero money in it, how much in dividends can they take out? That's right. Zero, nothing. Yeah, so you have to swing the piggy bank before you can pay money out. So you can, as long as you can cover dividends, it's okay. So in this case, they can have plenty of money left over, but you need retained earnings to pay the owners. Okay, I think just for ease, I'm going to copy these down to the next page. You can also do this if you want. We need these for the balance sheet. Ah, That didn't work out very good. Strange. Obviously, I messed up the formatting here. All right, well, darn. Okay. Let's go to asset. And what are assets? Okay, assets are anything of value. So anything that has a value to it. So let's go back up here to our accounts. Now we've already used some of these. There's two accounts that have value. Which ones are they?
The equipment and the common stock.
Close. The common stock is what you actually sell to the owners.
The cash.
Yeah, but now usually you do sell this for the cash, so it's not a bad answer at all.
Okay.
All right, so cash and equipment. Okay, yes. So our assets, so we have cash of 1,000 and equipment was what, 48? Kind of made a lot of space here. Okay, so the total assets would be those two together. I think it's 60,000. So these assets, these don't have value, and they're 60,000. Now we're gonna go to the other side. The liabilities. These are what is owed to people. It could be a bank, it could be a vendor, it could be whatever. So this is money that we owe to other people.
So like the payroll.
Yeah, the payroll definitely be one of them. I'm gonna mark these. Yeah, so up here, so we have two accounts left. Yeah, definitely the payroll. So if you make a payroll and you haven't paid it yet until you cut the checks, usually people do the work and then you pay them. And yes, if they do the work and you haven't paid them yet, it's a liability. Which of these two accounts? It probably looks like something you have to pay somebody.
Accounts payable.
Yep. Just that quick, I forget. 3,000. It's gonna look a little silly, but the total liabilities are 3,000. Probably don't need that, but. Okay. Our last lonely account is the common stock. And this is what we have sold to the owners. Oops. So we've given this stock to the owners. Okay, so, and stock can be somewhat confusing in that it's actually a certificate. It's electronic now, but they have tracking it electronically, but basically it's a certificate that says you own a certain amount of stock of this place. So you pay money, at least initially it's going to go to right to the corporation, and they will give you the stock certificates. So the common stock that you're talking about there, that is stock that is been given to somebody else on the outside, and they've given the company money. And the company will use that money for their business, for buying equipment, buying merchandise, buying, whatever. So, it's someone giving money to the corporation, even if it's one owner, even if it's the hot dog stand. Whoever owns the hot dog stand, they'll take their money and put it into the hot dog stand so that they can run the business. That is when they give that money to the business, they'll be buying stock. So the stock itself is a certificate of ownership that is given to somebody else, and that shows that they have ownership of it. And what they give to the company is cash. It could be other stuff. It could be equipment or something, but most of the time it's going to be cash that they give to the business. Okay, so, oops. Before I go down, let's make sure I know how much it is for you. So in our equity section, equity section, these are the owners. Okay, I know that's not grammatically right, but we'll go with it for now. Okay, so common stock. And these are virtually always sold for cash. It's possible they gave something else, land or something, but usually it's common stock. Now, the owners have one more thing that they own, though, that we're going to put in here. And that is, you recall, the piggy bank. So this piggy bank is also the owners. Now, this is the tricky part. It's always the ending retained earnings. It's very tempting to look up here and say, oh, retained earnings is 30,000. It's actually not. It is the ending retained earnings. So this is, I don't know if I can do it. I don't think it'll let me do an arrow from one page to the next. But that is what this is. This is the ending retained earnings. Okay, so the total equity is 57,000 even. Now, if we add up both sides of this balance sheet, so assets are 60,000, liabilities and equity, those also come out to be 60,000. And you can see that they balance. So the two sides will equal. That's what they call the balance sheet. It balances. And you might say, well, okay, that's cute. What does it actually mean? Well, here's what it's telling you. These assets of 60,000 came from somewhere, right? I mean, they had to have $60,000 worth of stuff that doesn't, appear out of nothing. So the question is, where did it come from? Well, they either borrowed the money or the owners kicked it in. So these assets can only come from one of two places: liabilities or equity. Borrow the money or the owners have the money. And that tells you how they got the money for these 60,000 of assets. So these financial statements, the income statement, know if you're profitable. How profitable are they? State retained earnings, this is the owner's piggy bank. And the balance sheet answers the question of where did the assets come from? So that is the balance sheet. So these are the three financial statements. Just to let you know, these have been around for 400 plus years. Businesses have been using these since people were sailing around on ships. So anyway, this is how they do. They keep track of things. And again, these three statements are hundreds of years old. And if you think about it, especially things like the income statement, things like that, when they look back through ancient civilizations and that, it's amazing how much of it is accounting. I think the first written thing they ever found were accounting records. Someone was keeping track of how many bushels of wheat or whatever it was. It's basically accounting. So, and a lot of it is this. What comes in with what goes out. Okay. Well, let's do another one. So if you go to page 4, now they're in a little bit different order. But basically there's a couple of changes here. What ones are new accounts? Accounts that we didn't see in the first one.
Wages expense, the utilities expense.
Yep.
And that's, the accounts receivable.
Yep. Yeah, so these are wage expense, utility expense. Now, what statement do those go on?
Those be on liabilities.
They will give rise to liabilities, but the expense themselves will actually go on a different statement.
Income statement.
Yep. Now, but you're absolutely right in that expenses and liabilities go hand in hand. Because the wages expense will probably also have a wages payable. We're not going to talk about that until probably next week. but the expenses and liabilities a lot of times do go hand in hand, because you'll have the expense that you owe people, and then you also have the liability, actually the expense that you're going to pay these people, and the liability that you haven't paid them yet. So these would be on the income statement. This one is a little bit tricky. Accounts payable is when you pay somebody else. Receivable is when you're going to receive it. So accounts receivable is when you're going to receive cash of 20,000. So where do you think that will go?
An income statement.
Nope. Where does cash go?
Statement of retained earnings.
Nope.
No? What?
It's an
Okay.
Yeah, this one is actually. So this,
That was gonna be my next guess.
and here's why it's an asset though. Because it's gonna turn into cash, and cash is the asset. Now, in later chapters, we'll figure out what happens if people don't pay, but for right now, assume that whenever there's an accounts receivable, that you're actually gonna receive money. So that's an asset. These two will go on the income statement. And I think I'll be quiet. I'll be quiet and see if you can figure out the financial statements. Give it a try. Don't be afraid to make a mistake. Okay, I think you should have gotten for the first two. Assets. Okay, cash is where has a value, 5,000. Not high spell value. And accounts receivable is going to eventually become cash. So this is going to become that. So that's why we count it as an asset. Liability. Okay, so we got cash. So accounts payable. And common stock. And what am I missing?
Ending, retaining.
The ending retain.
Yep, exactly. The ending retain, again, this is the ending retained earnings.
Do you want us to like highlight and change colors and stuff?
Nah, no, whatever works for you. I just do it. I don't know why.
Okay.
Yeah, I'm usually a classroom teacher, so usually this would be on the board in different colors, colored markers or whatever. And again, these equal, and what this basically tells us is where the 25,000 come from. Well, they borrowed 1,250, and the owners pitched in 23,750. So these assets had to come from somewhere. And so the question is, where do they come from? And that's what the balance sheet tells us. Okay. Here's your job for tonight. Oh, wait a minute. This is a few more things on it. I'll tell you what, I'll set this up and then we'll kind of I'll let you guys work on it for tomorrow. Well, let's go through these and see where they go, and you guys can do it. Okay, what kind of an account is cash?
Asset,
Yep. Inventory we haven't had yet.
would that be income?
Does it have a value?
Would it be income or a liability? Oh, wait, no, that would be an asset too, right?
Yeah, I think that, yep. Yeah, because it has a value. So, think about like a Walmart or something, whatever.
Right,
Equipment.
Asset.
income.
So, yeah, so these three, the first three. So these three are all assets, they all have a value. Okay, now we got payables here. What kind of account are payables?
Liability.
Yep. And mortgage payable is same thing as accounts payable. Basically, is that it's a liability. You owe it. I probably shouldn't do these as a singular. Common stock. What a heading does that go under?
Equity,
Equity.
Retained earnings is tricky. Actually goes in two places.
and that go in the statement of retained earnings, but then also the ending retained earnings would go in the equity.
Yep. So statement of retained earnings, I'm going to go ahead and make a so the equity would then have the ending retained earnings. So the 23,000 will go there, but then the ending will go in the equity section. Dividends, where do they go?
Retained earnings.
Yep, retained earnings. Revenues go where?
Income statement.
Cost of goods sold, we haven't talked about. Well, I'll tell you what it is. Cost of goods sold. Cost of goods sold is sort of like this. Suppose I'm selling a little toy here. I got a little motorcycle I'm selling. When I sell this motorcycle, let's say I paid, I don't know, paid $5 for it, and I'm selling it for $8. Okay. So someone comes in, they buy it, they give me $8. I give them this toy. Now it's not cash leaving the place, but it's a toy that had a cost of $5. That's the cost of goods sold. So I bought it for $5, sold it for $8. I made $3 profit on it, but I no longer have this toy. It left. Kind of like expenses or dollars leaving. This is actual merchandise, leaving the place. So
Is that an asset?
The inventory is an asset, but when it gets sold, then it's sort of like an expense. It's similar to an expense because I no longer have this, it's gone. This asset disappeared, just like if you pay a bill, cash disappears. Same thing here. The asset itself is disappearing, so it's to be counted as same thing as an expense. Oops. It's not technically an expense because it's not paid in cash, but it's very similar to an expense, and that is instead of writing a check for cash going out, the inventory is going out. Now, hopefully, you're selling it for more than you bought it for, but yeah. Okay, these are all the same. They're all. Okay. Okay. So this is kind of how you're going to use. So use this to take a screenshot of it if you want. This is basically how you're going to break up those and see if you can do the financial statements, and we'll call it a day. See if you can do the pages 6 and 7, and don't be afraid to make a mistake. If you make a mistake, your balance sheet is probably not going to balance. But again, don't worry about it. If you're not exactly 100% sure, well, first of all, you can email me and ask me. But again, don't be afraid to make a mistake. It's not it's not that big of a deal. Any questions on that? Okay, I'll see you guys tomorrow at 6, and then we'll finish this up, and then we'll see how to submit it into Blackboard. And I think that's it for this handout. Is it? Yep. Okay. So tomorrow we'll go over this and check and make sure that it's what you have matches what I have and all that. And then we'll see how to turn it in, and we might do a problem on the book. If we do, I'll have it with me, and if not, we'll do the practice exam. This quarter is going to go, or this session is going to go fast. It's basically things you cover in 2 weeks, you're going to cover in 1 week or less. So, any questions on that? Okay, now this video will be up. It'll probably take. It depends. It usually takes like a half hour to an hour to render it. And anyway, I'll have this posted in Blackboard, so you'll be able to see this either later on tonight or tomorrow. This exact video. And if you ever miss a class, all of these are recorded, so you'll be able to see them. Okay.
Okay.
Question I use?
No. Thank you.
Okay. Well, thanks, guys, and I'll talk to you guys tomorrow, and we'll kind of figure out a little bit more of this, and keep going. So tomorrow, see if you can do number 6. It goes on pages 6 and 7, and then we'll see how to turn it in, and that will be it for that. Well, for this handout. Okay, guys, and then this will be posted, and probably it should be posted tonight. So, okay, well, have a good evening, guys, and I will see you tomorrow.
Have a good night.
Good night.
Have a good night.
Well, you too.